mechanically for different people. For most, debt means monthly payments and interest piling up for things that either lose value over time or just consume themselves. Things like a car that's worth less every year, a house that locks up cash, or credit cards that compound against you. Now, the worst part is how this debt is paid. You see, for these people, debt is serviced with after-tax income. Essentially, you earn money, you pay income tax on said money, and what's left over goes to the bank plus interest. So you're paying taxes and interest rates at the same time. Every month, your paycheck comes in, and part of it immediately disappears. From the outside, it looks like debt is the problem. But that's the illusion. Debt isn't inherently bad. It only becomes bad when there is no leverage. For most people, debt is tied to unstable income, little to no collateral, assets that don't grow, and mandatory monthly payments. Miss enough payments and the bank takes the asset back. This is why debt breaks regular people. They borrow too much compared to what they own. In most cases, it's because they have no other option. So from day one, the balance is backwards. Their debt is large, their assets are small, and income is the only thing holding everything together. When you borrow this way, your bank becomes your landlord. You don't own anything, you're just renting it from the bank until the final payment clears. This is why consumer debt carries high interest rates. If your job stops, the payments stop. If the payments stop, the loan breaks. So the bank prices that risk in advance with high interest, strict terms, and no flexibility. Now, both the rich and everybody else borrow cash to pay for what they need. The only difference is the rich borrow less than what they already own. And this is where the story flips. To a bank, the most important question is how easy is it to get the borrowed money back? When you own assets that are large, stable, and appreciating, borrowing stops being a risky decision and becomes a liquidity decision. The bank isn't lending against your job, it's lending against your balance sheet. This is the key difference, okay? A regular borrower says, I need money to buy something. A wealthy borrower says, I already own something valuable, I want some temporary access to cash. And that changes the entire relationship. Instead of evaluating income, banks look at collateral value, volatility, loan-to-value ratios, downside protection. If you own a $20 million asset and borrow $5 million against it, the bank isn't worried. Even if things go wrong, they're covered. That's why interest rates drop. That's why terms loosen. That's why flexibility appears, because the loan isn't what makes you risky. Not having assets does. And this is how the rich can get way better deals from the banks. But this answers only half the question. Here's the part that sounds impossible the first time you hear it. The rich don't take loans with the intention of paying them back. And that is how they actually get to live on loans for their entire lives. Now, before we break down how this works in depth, I just want to take a moment to remind you that inside the ALX app, we go deep on all kinds of topics designed to help you level up your game, to grow wealth, to secure wealth, build confidence, start a business, even have healthier, more stable relationships. The app is basically an ecosystem for entrepreneurs and high net worth individuals, especially with the launch of the ALX Network, our latest addition to the app. It's a vetted community of your peers, people trying to achieve similar goals to you that you can talk shop with, get insights from, compare notes, and offer support. And if you download the app at alx.com/app and scan this QR code, you'll get 25% off your annual membership, which is a tax-deductible expense, by the way. All right, with all that said, let's get back to it. How the rich actually live on loans. So the first step in making this work is building assets that banks trust more than people. Before any loan is taken, the groundwork is already done, and the assets the wealthy own share a few key traits. They appreciate over time, they're relatively stable, they're easy to value, and they're easy to liquidate if needed. So things like public stocks, income-producing real estate, and private businesses with predictable cash flow. From a bank's point of view, these assets are safer than your job. A job could disappear overnight. A diversified portfolio or a prime property rarely goes to zero. Step 2, they borrow a small amount relative to what they own. Now, this part is important because this is what allows them to get better deals. If you own $10 million in assets, you can't just go to a bank and ask for 100 on the premise of, trust me, bro. But you could get $1 to $5 million if you own $50 million in assets. This is called a low loan-to-value ratio. So in other words, the bank is more than happy to give you the money and at a low rate because you are extremely low risk. Technically speaking, you could pay back the loan anytime you want, but you don't. Ever. And this is where step 3 comes in, okay? The loan is structured for flexibility, not payoff. And there are 2 ways that loans work. Most people